Welcome to the daily update, where I'll go over the action in the market for Monday, July 29th, and then we'll see how things look for Tuesday, July 30th. We started to see a bit of an upward move, but we pretty much gave that back. We're not really seeing anything all that definitive, at least in Monday's session, because it's a pretty big week that's coming up. We're going to have the Fed coming out on Wednesday. They're probably not going to change interest rates, but it's going to be, what do they say? How do they say it? And the market's really going to be tuning into that to see if they're going to give any signs that there will be a rate cut in September. And then we're going to have the employment situation report on Friday. And in between all of that, we have earnings reports that are coming out. In the short term, we are still negative. Our charts are looking more negative, and we're just not seeing much of an improvement there. In the intermediate term, we have negative charts, but we're still above the 50-day moving average. So there's a bit of a mixed picture there. And there's some weakness that is starting to come in where we're still positive in the long term. I do have a thing called the SPXInvesting Program. I'm going to be locking that down in August. It's freely open for right now. Feel free to check that out. And even if you check it out and you decide not to be a member after I lock it down, I intend on rolling out a free portion where I go through just a basic overview of what's happening in the market. At some point in the future, I'm also hoping to roll out a newsletter version of this video, but that takes quite a bit of time, and I'm doing so many other things right now, I just can't focus on that. If you want to find out more about the program, there is a link that will take you to the website. There's also a link that takes you to some videos where you can learn more about that. Also, I do a number of videos each week. The daily video that you're watching right now is the main foundation of the analysis that I do. All of the other videos are more supplemental, and they're supposed to feed into the daily video. So let's go back and talk about what happened, and then we'll look at some charts. We had a higher open. The futures were fairly strong before we opened on Monday. Prices climbed up to R1 at 54.88, which was just about the high that we set for Thursday. And then we had another high just around that level on Friday. Kind of interesting. That was also the high on Monday. Prices then declined down below the unchanged level and the daily pivot. They were pretty much on top of each other at 54.59. And we did find support at 54.50, but we're still just a little bit above the 50-period moving averages before we tried rebounding back up, and we got up to that resistance again at R1. Then we just drifted lower from there, and there was a feeble attempt to bounce later in the day. That fizzled out, and then we closed slightly above the daily pivot and unchanged level, which means we closed just slightly positive. So we were up 0.08% on below average volume. Not a surprise there. It's summertime. Didn't have any economic reports. Bigger things are happening later in the week. So to see volume dropping back is not really all that of a concern and not all that unusual. We are still negative in the short term, tipping around between positive and negative in the intermediate term, with most of our charts leaning towards the negative side, where we're still positive in the long term. And we're going to get some inflation and interest rate information out this week that will hopefully give the market some more direction according to that. And then all the geopolitical things that are happening. Yes, there's more than what's going on in the political arena in the US. There was an escalation of things over the weekend in Israel. Now it has the danger of actually growing into something bigger, but that doesn't really seem to have an impact on the market, at least yet. There was the opening of the Olympics in France, and yes, they do actually have sporting events. That's kind of what this thing's all about, but you wouldn't know that by the news coverage that's happening. That won't have an impact either on the stock market as well. But we still want to keep an eye on these things because sometimes they do have an impact, if even on a short-term basis. Some comments. We're in wait and see mode right now. I always wanted to have a boat and call that wait and see, but spell C-S-E-A. I thought that would always be kind of a neat name. Don't steal that from me, please. Wednesday, the Fed's going to be meeting, and then we have the big employment situation on Friday. We're still above the 50-period moving averages. On a short-term basis, we have the Stochc RSI and the stochastics. Those are our only two extreme negative indicators right now. Intermediate term, we still have the Chaikin oscillator. This is one of the three smart money indicators. And this should be extreme positive, but I've got it on the wrong line for some reason. We're still looking pretty good on a momentum basis when we look at the 10-period moving average of the new highs minus the new lows. And longer term, the moving averages are still looking pretty positive there. And it does look like, from a probability perspective, and if you watch the videos over the weekend, I addressed this, that the Fed's going to leave rates unchanged at their meeting coming up. They're actually starting on Tuesday, and then they'll conclude on Wednesday. But the market is really, really thinking, hoping, and expecting that the Fed's going to cut rates in September. Now, if there's some kind of talk out of the meeting on Wednesday that we higher for longer, let's wait and see, that's the name of our boat too, that's really going to disappoint the markets. If they come out and start to give some clues that that will happen, because the market is pretty much already anticipating that, that may not have as much of an impact. But if they come out with a little bit more dovish type of statements, then that could really be some support for the markets. The dollar was up and interest rates were down. We closed at 4.18%, where after Friday we were at 4.2% with the 10-year yield. We're still inverted with the yield curves. Sentiment is neutral. It ticked up one notch to 46, where it had been at 45. And our trend is still negative. We still have the red line on top, even though it has been declining. The ADX itself is below its moving average. That suggests a weakening trend, but we're still above 20. So we're in a trending environment. We're coming down from 40, but we're still above 20. With the slight update that we had, and then the update from Friday, our bias is positive, and I've switched our momentum over to mixed. We've got some negative things happening under the surface, but it's not really falling apart yet. But there is some weakness that we're seeing. There's also some rotation that we're seeing. And as the market works its way through this, we're not sure, is this going to help prices to go higher or lower? So we kind of have a mixed environment right now over the last number of days. We didn't have any economic reports. There's no charts there. Here's some Isabel Net blog charts. When the S&P is higher for the year, big gains are perfectly normal. Well, depends on how you read that. I'm glad they have the comma in there, but it's just strength builds upon strength, just like weakness builds upon weakness. So when we have 7.8%, the average for the whole year, the return when it's higher is then 19%. And the return when lower is 13.9%. And this is just what the markets are figuring might happen, where the red line, that's Republican, and that's been dropping off as there's been a change in the candidate on the Democratic side. And so that's giving a little bit of push to the Democrats as they're coming back up, but we're still seeing a pretty wide gap between the two, according to this chart. And then the probability of a recession, it's still under that 60% level, but it's right around the 50%. It's kind of in between 40 and 60 right now. These are asset flows over the last 4 weeks. We're seeing a lot of money going into money markets, actually coming out of money markets here with the solid blue line. But we're still seeing a lot of money in money markets themselves as people are taking their money out of banks and putting into higher yielding money market accounts. And then looking at government bonds, they're still seeing inflows there. Corporate bonds, which are more, they're a little bit riskier than government bonds, but less risky than junk bonds. And then you have emerging markets, seeing a little bit of money going in there. The high yield, those are junk bonds. Balanced funds, stocks and bonds together. And then developed markets and emerging markets. You can just kind of see where the different money is going in these days. And corporate sentiment, this is measured a little bit different than the sentiment that we look at. It's actually ticking down a little bit, but it tends to always be negative. This is the average negative sentiment score. This goes over the last 20 years, but this was also as of the middle of July. So this is a little bit outdated right now. But overall, it's still fairly strong, stronger than it has been as far as sentiment is concerned. And then GDP growth, and where does it come from here? This is the actual amount that we have. And now these are all forecasts. We're still dealing with the second quarter and into the third quarter. And this breaks it down on where does the growth in GDP actually come from. And you see the green at the top, the lighter green, that's government spending. Yeah. All right. Didn't really find anything interesting on Twitter. A lot of just blah, 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 but nothing any that really gives us any insight here. Here's the intraday chart. We did have a higher open, and notice how we hit that high on Thursday. We hit just a little bit below that on Friday, and a little bit below that. You could read something into this, that this is a series of lower highs, but I don't know. It's really getting a little nitpicky in my opinion. But we're getting near this overall range here. We just can't seem to break out above it, which ended up being R1. So that's what I was watching for as the market was open, but we just can't seem to get above that. Then we turn around and go down. We didn't get down to the 50-day moving average. We stayed a little bit above that. Then we tried to get back up to R1 again, couldn't quite do it. Then we just drifted lower, tried to drift higher, and then saw some selling going into the close, but we still ended up closing positive. Here's our intraday chart, where before the market even opened, we were pretty much flat. And then we saw a nice little pickup in the futures, but then really the highs over the last 24 hours after the market opened came during the time when the market wasn't even open. It's when the futures hit a high and then ended up drifting down from there. And we're down a little bit, but seeing a bit of an improvement as we're coming back to more unchanged in the initial overnight session. And we are seeing where value is outperforming growth. The red line's above the blue line. And this is what's holding the market back right now. Also seeing a deterioration here over the last number of days when we look at growth to value intraday for the S&P. That has been trailing off. Looking at our end of day charts, growth was up where value was down for the large caps. It was down slightly more for the mid caps and about half as much, well, not quite, less for the small caps than it was for small cap value. But we're not really seeing any improvements here. With small cap growth to value, it's continuing to decline. Mid cap growth to value is also still declining, and S&P growth to value ticked up a little bit, but is still not looking all that solid right now. Our growth versus value ETFs continue to be inside the rainbow, even though it ticked up just a little bit. And discretionary to staples, yeah, it ticked up, but it's not really showing any leadership or any really big advancements right now. And this is what's holding the market back. Large cap growth was up just a little bit, but still underneath its 50-period moving average. We ticked up a little bit here with the large cap to small cap ratio after this had really been coming down, meaning the small caps were outperforming. Well, in Monday's session, the large caps slightly outperformed again on this ratio basis. We're still above the 50-period moving average with the Wilshire, and this is a broad market measure. And so this means that the broader market is still hanging on to more of a positive slant. Here's our trend where we're still declining with the ADX. That's the dark black line below the moving average, and we're below 40. So we're not getting that extreme reading anymore. The red line's on top, so we default to negative, but the red line is declining, or the green line is pretty much declining to flat. And when we look at the short-term chart, we're trying to turn up here, but we haven't crossed the moving average yet. The red line is still on top, although it is declining. And we dropped off a bit with volume, but over the last few trading sessions, we've been above average with volume, which is kind of strange because usually July and August, those are the times when people take time away from the market. Excuse me. But other than in Monday's session, we've been seeing volume remain pretty healthy. And we see that also for the NASDAQ as well. Here's the weekly chart of sentiment where they still have all of these different gauges showing us 82.2 right now, which is extreme positive. That's different. We're neutral now when we look at the sentiment gauges that we follow. Here's insider transaction ratio starting to go up a little bit. When this gets up pretty high, that tends to be bearish for the market. And here is the insider buying ETF, where it's really just chopping more or less sideways right now. The Ulcer Index is continuing to go up, showing there's an increase in fear. We ticked up a little bit on a closing basis with the VIX on the line chart. And it looks like we're coming down off of these really high readings with the bar chart. And the VIX of the VIX also decreased since we had a slight update, and we spent most of the day in positive territory. So it's not a surprise to see the bar chart and the line chart coming down here. But the momentum of the VIX still continues to be up, even though the MACD is rolling over just a bit to measure momentum. And this is the historical seasonal chart that we're looking at here, where this is a few days out of date right now, the red line. That's what's actually happening. But typically, what we often see in August and in September through October, the start of October anyway, is an increase in the VIX. And that when the VIX is going up, that means stocks are going down. And here's the equity put call ratio for the day. It was down, but we're still going up with the 5-day chart as well as the 10-day chart. Volatility risk premium is coming back down and actually starting to drop below this band as we're seeing a real decrease in the risk premium currently. We tick down with this fear gauge. We tick down with this other fear gauge as well. So we're seeing some confirmation there. We declined just a little bit with our risk on to risk off ratio, where, as I've been pointing out, we've been in range bound for all of 2024. Now we're getting to the lower end of this range. If we start to go back up and turn to a risk on position, then we would go back up in this range. Our advanced decline line study still holding up for the most part. We're seeing price not really breaking out, but not breaking down either. Where we're seeing a bit of a negative divergence is with volume, where we've been going sideways lately with price. We actually saw more of a decline, and we have a ways to go to get back to this previous high based on volume. And we did see a healthy advance of new highs, not really expansion of a new lows. We're pretty much sideways to slightly down with the 5-period, and we're still going down with the 10-period average. We're positive here with the advanced decline ratio. Both lines are above 0 and advancing. This is where we're looking more negative, though. This is one of our 3 smart money indicators. We're below the moving average, and the moving average is starting to come down. We had got to an extreme negative reading. We've been able to work that off again, but this is still negative overall. We showed a little bit of an improvement here with the chicken money flow, but we're continuing to decline. And we're extreme negative, even though we turned up slightly with the chicken oscillator here. So all 3 of these smart money indicators are negative, with the chicken oscillator being slightly extreme negative. The cumulative advanced decline line for the NYSE did show a nice little decline here, but we're still above the 50-period moving average. We ticked down just a little bit with the NYSE regular advanced decline line, also ticking down very small, hard to see with the other NYSE advanced decline line. We ticked down a little bit here with the NYSE common stock based on price as well as volume, but you can see we came almost back up to this previous high based on price, where we still have a ways to go based on volume. Looking at the S&P cumulative advanced decline line based on price, not quite back up to this previous high, where we see another negative divergence. Even though it improved on Monday, we're seeing more of a decline based on volume. And the NYSE advanced decline line continues to outperform the S&P 500. It's above the bar chart, even though they're on different scales. So our advanced decline line is still hanging in there with our different studies with the NYSE common stock, the S&P, the mid caps, and the small caps, where most of these, except for the S&P, did decline. They're still well above their moving averages. And we are still maintaining price above the 50-period moving average on top. On bottom, we did drop to below average with volume. We're still extreme negative with the Stochk RSI, even though it's trying to bounce up a bit here. We're no longer extreme with the Williams percent R. We're just coming out of being extreme with the CCI 14 as well as the CCI 20. And we're seeing more weakness with our 20-period double and triple exponential moving average study. We're below the lines. The lines are declining. The green line and the blue line are actually coming down now. So this is showing that there's still some more weakness coming in the short-term time frame. We're pretty much flat to slightly up with the 20-period. We were flat with the 50, and we actually advanced a little bit with the 200 moving average study here. Saw a little bit of a bounce up, but still negative with the force index. And we're no longer extreme in the short term with the stochastics. We're still extreme, but turning up in the intermediate short term. We're still declining and negative in the long short term. Look at this. And as I like to explain, this is a further subdivision of the short-term time frame. So we have short term, intermediate short term, and long short term. Looking at the 20-period moving averages, we're still below them, and the lines are starting to head down a little bit more, especially the blue line, which is exponential. That moves faster. And we're still below the midpoint here with the standard deviations chart. Intermediate term, we are negative, but we ticked up with the balance of power. We're still negative with the go, no-go system. We're negative here as we get closer to the red line, which is the lowest low value, and the midpoint is also starting to roll over. The TTM squeeze continues to be more negative and still is declining. Looking at the 50-period double and triple exponential moving averages, we're starting to see the red line coming down below the blue line. The red line moves faster, and prices above both of these lines as they begin to roll over. But when we look at the simple and exponential moving averages, we're still hanging out. This is pretty significant support. Are we going to be able to bounce up off of that? Are we building some kind of a base here that we can launch from? Or is this just wait and see mode until we actually drop below it? We don't know that yet. You can make a case for either side. And we want to keep an eye on the 100-period moving averages just in case we do see more weakness. The ease of movement is still below zero. That is negative. The Arun is also negative since it's below zero. We're still positive with the S&P McClellan oscillator since we're above zero. So we're going up based on price. We're going down based on volume. This is another negative divergence that we're seeing. That's a concern. We're positive even though we came down with the NYSE McClellan oscillator, but we're still above zero. So we're going up based on price and volume here. The Swenlin trading oscillator, also a negative divergence. We're going up based on price. We were flat based on volume. We're positive with price. We're negative with volume. Momentum still has us going down with the PMO. We're still looking positive here based on price. We're above the moving average where we're going below the moving average based on volume. So we saw a little bit of an improvement here with the PMOs that are rising. We're flat with the buy signals, and we're flat with the PMOs that are above zero. And we're neutral with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR. We're declining and below the midpoint with the slope oscillator. We're also declining with the MACD. So all of our oscillators in the short, intermediate, and long term are showing negative momentum. But we still remain camped out at the 50-period moving averages. That's positive for the intermediate term. We're negative because we're below the 20-period moving averages. The bullish percent index continues to hold up fairly well. We're above 50. That's positive, and it's not really falling apart at this point, nor is it showing an awful lot of strength at this time either, but it's hanging in there for the time being. This is what's actually looking more encouraging. We're seeing the NYSE bullish percent index actually going up and is well above 50, where we ticked up a little bit, but we're negative with the NASDAQ 100 bullish percent index. The money flow is still above 50, even though it was flat, where the ultimate oscillator is bouncing up after being extreme negative, but it's still negative. The vortex is negative with the red line on top. RSI 14, we're below 50. Also with the RSI 9, that's more negative. And we're slowing down a little bit, but we've been seeing a real move down with our standard deviations chart over the last 10 periods. That just means we were moving fast. It doesn't measure direction, it just measures speed. We're still positive with the unbalanced volume. We're above the moving average, and we're ticking down a little bit, but still positive with those stocks in the S&P above their 20-period moving average. Still looking, I guess, okay here with our study that we've been following. Saw a little tick up with those stocks above their 50-day moving average, and a little bit of a tick up above their 100 moving average, and actually a bit of a decline with those stocks above their 200-day moving averages. The Copic curve, another momentum oscillator, is declining. That's negative, and we're still getting a Pring bottom fissure signal that was generated, and it's not necessarily when we use this particular indicator. We're still looking more neutral with the Sean trend meter. And the reason I'm showing the Ichimoku cloud here is we're seeing the blue line dropping below the red line. That's turning it more negative. When we're going up, the blue line wants to be above the red line, and the green line is also declining. It's really hard to see because it gets mixed in here with the bar chart. We're still looking okay here with the broad market 5-period moving average of the highs minus the lows. We're still above zero, even though we have been declining a bit. And we came right back up to this R2 level. We closed pretty much on it after Friday. We dropped down below it, but we were able to close within about 1.5 points of this level in Friday's session. And we climbed just a little bit above it on Monday. This is longer term positive for the time being. Keeping an eye on the fib retracements marked to the all-time high in case we really see more of a decline. And we're below this little mini rainbow here based on 20 periods. And the longer we stay below this, the more these lines will begin to roll over. And we're still above the 38.2 fib extension here with the S&P 500. And we're seeing a mixed picture here. This is actually somewhat positive with this. It's really small, but it's an open candle with the hike in Ashy after it had been all black candles. But we're negative, but pointing up with the Kegi chart. That's negative with a positive slant, where we're still negative with the Renko chart, and we're still negative with the 3-line break chart. Long term, starting to break a little bit above this level here with the 150, and we're above this level with the 200-period moving average study, which, yeah, it's overextended, but it also shows longer term positive momentum at the same time. This is also a little bit longer term with the S&P 500 highs minus the lows over 10 days. We're still above this green line, even though we're coming down. This is also suggesting good longer term momentum. And we're negative with the S&P and NASDAQ 100 in the short term. All the other indexes are positive on all the different time frames. Again, we're negative in the short term with stocks. We're negative in the short and intermediate term when we look at commodities and the dollar, where bonds have now switched over to positive across the board. And after, well, on the 24th last week, we had a downward move with the decision point trend model here. Now, we should be negative with the PMO signal, but they haven't changed that yet in the short term. And we saw lots of blue or green here as far as the alerts, with the S&P getting back above 5,400. And we saw kind of a mixed picture here with discretionary and communication. These are two of the more growth areas. They did the best, where we saw tech ended up being down and energy being down the most. And we're still looking good here with the NYSE new highs minus the new lows. The black line here, that's just the daily score. And then the red line is a 50-period moving average of that score. We're still seeing the equal weight holding up better than the S&P weighted index, even though we declined just a little bit here with the ratio. The Dow is still holding out above this pivot point, still above its 50-day moving average, and still continues to be positive with the Elders Impulse system. We're still below the 50-day moving average with the NASDAQ and below this pivot point. The NASDAQ 100 also bounced up off of this pivot point, but still below the 50-day moving average and this other pivot point, which could end up acting as resistance if we see a move up. And we're neutral with the QQQs when looking at the Elders Impulse system. The momentum for the NASDAQ 100 continues to be negative. We're still below the 23.6 fib extension here. After getting up to the 50%, we have been falling back. The Qs are still below their 20 and 50 period moving average. That's why I've been focusing more on the S&P 500 50-day moving averages, because we just blew right through the QQQ 50-day moving averages. And that means the value is holding up better now than growth. So we'll have to see if this is going to continue or if we'll see some improvement. The small caps gave 0.68% back, still have not been able to break out above this previous high, but still kind of the darling area for right now. But they continue to be neutral after being positive with the Elders Impulse system. Looking at the Russell 2000 small caps, declined but still above 50 with the RSI, still above the 50-day moving average, and the momentum is still positive. And we do a ratio between small caps and the S&P, we came down just a little bit. And I pointed this out over the weekend, where this is showing an improvement, but longer term, small caps have a long ways to go to start outperforming the large caps. The mid caps still hanging out above this pivot point level and still above their 50-day moving average. And they still remain positive with the Elders Impulse system. The total US stock ETF is still hanging out above its 50-day moving average. Are we going to be able to bounce up off of that, or are we going to fall down below it? Apple was up just barely, still above its 50-day moving average. Tesla, we're starting to see a golden cross here now. It was up 5.6%. So it was back up after it really had been falling back. But this is switching from negative over to positive with a trend basis being measured here. NVIDIA was down 1.3% and below its 50-day moving average. We were up 1/3% with Microsoft, still below its 50-day moving average. And Meta was unchanged on the day and in between its 50 and 200-day moving averages. Amazon was up 1/3% and below its 50-day moving average. Google was up 1.5% and still has a ways to go to get back to its 50-day moving average. Netflix was down 0.7% and below its 50-day moving average. Yeah. FANG index still below its 50-day moving average, even though it was up 0.71%. We are seeing a climb here with the staples to tech ratio. Now it ticked down just a little bit. We're wondering, is this 200-day moving average going to provide overhead resistance with this ratio? It did before when we had the declines in April. Is that going to happen again now? This is another new chart. I showed a weekly version in the weekly video, and then I showed this in the intermarket analysis video. I've had this chart for a long time, but I never saw a need to show it because it was irrelevant for a long time. This is a ratio between the small caps and the tech sector, where the tech sector had been the real darling, and that's when we see this going down. That means the tech sector is outperforming. Well, now that the small caps are potentially coming back into favor, we're seeing a bit of a bounce here, but we haven't seen a golden cross yet with this ratio. So we're going to be watching this chart. And this is a daily chart where I also show a weekly version in the weekly video. The dollar was up and is still in an uptrend these days. And we look at the relationship between US stocks and world stocks. The shorter term correlation is fairly strong, where we're could be bottoming out here, but not as strong when we look at the longer term correlation. We were down with the 10-year yield. We were up with the 10-year based on price. This is more encouraging too. Home construction ratio to the 3 to 7-year bond. This continues to go up, and home construction is very interest rate sensitive. If we're going to see a cut in interest rates, that's going to help this ratio to go up even more. If we don't get it, it's going to really send this ratio going down. Then looking at our growth to value ratios, not really seeing anything here. With Qs to S&P, a little bit of a tick up with discretionary to the S&P, and large cap growth is underperforming large cap value. So with the large caps, mid caps, and small caps, just not seeing any strength right now. We're still positive with the advanced decline line based on price, and we're positive again now based on volume. And we're still declining here with the S&P to utilities ratio. When this goes up, that is positive for the S&P. When it's going down like it has been, that's negative for the S&P. And when this is going down, that's positive for the S&P. And this has been starting to go up when we look at the staples to S&P 500 ratio. We still don't have a confirmation yet after Friday as of a Hindenburg omen for the S&P. Now, you listen to the perma bears and they think, oh, this is a done deal. No, we don't have it yet. Now, there is a 1-day lag on this chart, so it could come in at any time, but we haven't received it yet. We have until this Friday, which will be August 2nd, for that confirmation signal to actually trigger. And we've had confirmations with the NASDAQ, but it's pretty much ignored that. Nobody told the NASDAQ that it's supposed to crash with all the humanity. All right, so what's our outlook then for Tuesday? About 35% of the companies, now there's been just under 50% that have already reported. Another 35% of S&P 500 companies will report earnings this week. This will include Microsoft, which is going to be after the close on Tuesday. Meta is going to be after the close on Wednesday. Apple and Amazon will be after the close on Thursday. So there are some pretty big things happening. And in between all of that, you have the Fed meeting on Wednesday and the employment situation on Friday. We are still negative with our technicals when we take everything together, except in the long term, but we're still above the 50-period moving averages, and we have to respect that. We're going to get the FHFA Housing Price Index and the Case-Shiller Home Price Index. So we're getting some housing information this week. And then consumer confidence will also be coming out, and all the different geopolitical events. And I changed the France election over to France Olympics. I hope nothing happens, but I remember 1972. It was the first real Olympics that I paid attention to, and that was in Munich, Germany, and there was some deaths there from terrorists at that time. I really, really hope nothing like that happens. Let's just play the games and have everybody do their best. We're also really paying attention to what's currently going on with the US election. Everybody has an opinion, but nobody's right until after the election actually takes place. All right, here's the economic calendar showing on Wednesdays when we're going to get the employment cost index, and that's when the Fed will come out at 2 p.m. Eastern with their announcement. We're going to get ISM manufacturing on Thursday and then the big employment report on Friday. And here is showing we're going to get the JOLTS job openings as well in Tuesday's session. Somehow that didn't show up on my other calendar. Seasonally, we're neutral to negative with the Dow, but we're flat out positive with the S&P and NASDAQ. So that's looking a little more encouraging. And we look at the seasonal chart here, we might get a little bit of a bump as we're going into the end of July here. We just have one more trading day after Tuesday. And we might see a little bit of a bump. And then sometimes we see a little bit of weakness going into the last trading day of the month. And we're still kind of far away from all election years taken together. So some of this weakness that we're seeing may be a reversion back to the mean. Tuesday is kind of a flip of the coin. It's slightly a negative edge based on what happened in 2023. And we don't know where we're at now. Is this a lame duck president? That's kind of what it is. We're fourth year of a new president. Well, it's the president's fourth year, but not a new president anymore, because after this, there's going to be another new president. What's that going to do to all the seasonal charts? And then looking at, we're still in a fairly positive time here when we go finish out July, see a little bit of a dip in August, and then positive seasonality through September. And again, what do we make of this? It says the election year of a new president. That's no longer valid. And here's the election year, which tends to be more choppy than a non-election year. And we're now just finishing up the second half of July. And then here going into August, this is looking ahead just a little bit, where we do see some positive seasonality. Not as much as we typically see in July, but it's still positive nonetheless. And then our warning signs, we're still keeping an eye on staples, utilities, and healthcare, but growth is just not doing anything right now. Discretionary is not really doing all that much compared to staples. As we're seeing all those relationships not really helping the market right now. The equity put call ratios, both the 5 and 10 period, are going up. That's more negative for the market. And we look at our three smart money indicators: accumulation, distribution, the chicken money flow, and the chicken oscillator, which is still extreme negative, but all three together are now still negative. The parabolic SAR, the ease of movement, the vortex, our oscillators, the ultimate oscillator, the Koppel curve, all of these are negative. And the momentum for the NASDAQ 100 and the bullish percent index for the NASDAQ 100 continue to be negative. On the positive side, we're still looking pretty good with the bullish percent index for the S&P. The advanced decline lines are hanging in there, and they're positive. They're above their moving averages. And we're seeing a negative divergence here with the S&P McClellan oscillator and summation index. We're positive based on price, negative based on volume, where we're positive with the NYSE oscillators and summation indexes. We are mixed with the Swenlin trading oscillator, positive based on price, negative based on volume. The money flow is positive though, and the NYSE bullish percent index, it's actually looking pretty good right now. The financial sector is positive as well. So our conclusion, we're negative when you take all our charts together, but we can't go fully negative until we really break below that 50-period moving average. And as long as we stay above it and go sideways, that's potentially building a base. But we're not really seeing that in our charts, at least yet. In the short term, we're negative since we're below the 20-period moving averages, just slightly oversold at this time. Intermediate term, we're negative, but above the 50-period moving averages, and we're still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.